Hello my fellow investors and welcome back to Invest Like a Guru. Today's video is all about interest rates and their effect on historic stock prices, or at least their correlation with historic stock prices. I did a video in Danish the other day, and in there I promised a more in-depth interest rate video, and here it is. Now you probably all realized that the interest rates are going up. And markets are a bit volatile and nervous because of this. Of course, there are some sectors and some specific companies that are a bit in pain because of the potential for higher interest rates because they are a lot in debt. But I'm not going to look too much at that today. What I am going to look at is I'm going to look at a report that I found about this. It is by a man called Marc Deschamps here, and he's saying that you should get ready for a climb in the stock market because the interest rates are going up. He is showing some data here, and I'm gonna go a bit more in depth here because there are some statistical errors in here, but I will say right away he's not completely off. There is a thing about the rate hikes and the rate cuts that we can actually see in the stock market as well. Then I am gonna show you, could I say, the real numbers, or at least some more data points than he has, and we are gonna calculate it in a bit of another way. And finally, I'm gonna show you the overall performance of different sectors in different interest rates regimes. So buckle up, I'm gonna make it as quick as possible, but some of it takes a bit of explanation. First of all, let's have a look at Deschamps here and his data sets. What I criticized the other day in my Danish video was that he is looking at rate cut cycles and rate hike cycles. And then he's showing us that in these rate cuts, the markets are going up sometimes and they are going down sometimes. And as well with the rate hikes, we can see there are some uptick periods and some downtick periods, or at least one here. First of all, these are very few data sets. And secondly, what he's doing with the average here is he's calculating the average performance in these markets, but it is in different time periods. Here we have around 5 years, then we have 2 years, then we have 1 year. Down here we have 11 years down here. And he's making these numbers here show that from 2008 to 19 in the rate hike cycle, we saw some massive performance here in Dow Jones, in S&P 500 and in Nasdaq, and then they are calculated in the average just with the same weight as the rate hike cycle that went on for a year here. That is not really the way to do it, and what we'll do today is we will calculate the CAGR, meaning the compound annual growth rate. So we'll see in this period, for instance from 08 to 19, how much did the market go up per year, which I think is a lot more fair way to do it. So let's have a look at it, because what he's claiming here is that when the rate hike cycle starts, we actually see some more gains in the markets than when we have the rate cuts, or at least that is what the averages here shows us. So let's see if that is correct. In here we have data sets back from 1980 and up until 18th of January 22. Now what we have done here is not count from the day interest rates started to go up or down. We have taken a bit of a subjective look at it and said, well, in the steady regimes, the rate might go up by 0.25 or 0.5%, and then a bit down again, and then a bit up again, and so on. So we have a stable interest rate regime, maybe a bit up, maybe a bit down, but overall, looking at it historically, this is a steady regime. Then we have, of course, the downwards regime. That can be a cut, then maybe a couple of hikes, and then some huge cuts again. And of course, the other way here with the up regimes. So this is not a trading strategy, because we're looking at this in hindsight and just seeing, can we see any specific developments in the markets at the times where the interest rates are going steady sideways, the periods where they are getting cut, and the periods where they're getting hiked. All right, so what can we see here? Well, first of all, we have a lot of regimes. We have steady, down, up, and they are shifting back and forth here. We have different year spans where these periods are running on. You can see here from 08 to 16, it was actually steady for 8 years. Let's just have a look at it here. What is going on, looking at CAGR and Sharpe ratio and so on. In the steady regimes, and that is overall since 1980, that is around 26 years. There is an average CAGR, meaning an average compound annual growth rate at 11.6% per year. So in steady interest rate regimes, we can actually see that the market is going up fairly nicely. We can also see that the average volatility, meaning that the markets might be going up, but by how much volatility? Are they going up like this, or are they going up like this? There's a huge difference here, and that is the volatility that we use to calculate our Sharpe ratio with. The Sharpe ratio tells us if we are getting a good performance compared to the volatility. And in a steady interest rate environment, we actually see that we get 11.6% per year. We get a medium volatility here, and the Sharpe ratio about 0.72. So if we were only invested in the market in the periods with steady performance or steady rate regime, we would get a quite good yearly performance with some volatility. Now in the downturn regime, meaning the rates are going down, we can see that, and that's over the last 42 years, that is just around 9.5 years, we can see that the average performance per year in these periods are actually 5.5%. So you could say that right now, when you're looking at the market, you're reading the news, and maybe Fed is saying, yes, we are going to lower the interest rates a bit. Then you might see the market overall tick upwards because people are seeing cheaper money they can borrow and so on. But looking at the last 42 years, in the regimes with rate cuts, in the regime with rate cuts, we actually see an average loss per year. That is, of course, if we're looking at the data, and that's one of the reasons why we actually needed more data. That is, of course, because some of the downtick areas here are in the period with for instance, the financial crisis. And of course, the market collapsed there. We also see it in the beginning of the 90s here. We actually had a decent performance there. But we see it here around the dot-com crash, where we saw a collapse in the market as well, a negative of approximately 12.3% on average per year in this time span here. So what we're looking at here is actually that the downturn in rate, the rate cuts, they are coming in times where the economy is in some dire problems. So we are not really seeing that the stocks are going down because the interest rate is going down. We can see that the interest rate is going down because, let's just draw the little cycle here. The interest rate or the economy starts to get bad, meaning that to save the economy, the Fed or the central bank is lowering the interest rates. But the stocks are also dropping on average. But it's not because of the interest rates, it's because the overall economy is actually in problem. And we can see here that when we take a look at the next regime here, which is up, that is around 8% altogether of the 42 years, we can see that in the period with rising rates, we actually see the highest average CAGR, meaning that on average, the stock markets are going up 14.9% per year in these periods. So right now we are entering a period with rate hikes, as you know, probably 3 or more rate hikes here in 2022. And that means if the statistics hold as we have put them in here, it actually means that we can expect some rising markets this year. Now there are of course differences from time to time, and we can see maybe what is called an inverted yield curve building up right now, meaning that the shorter term interest rates are getting higher than the longer term interest rates. That's a longer story. But what we can see, what we can expect maybe statistically, is actually not that bad. We can also see that in periods with rising rates, we can see that the average volatility is of the lowest of these three. Meaning that when we get an average CAGR of 14.9% divided by the average volatility, we are actually getting a Sharpe ratio of 1.1, which is something that many fund managers would kill for, a Sharpe ratio above 1. So that is the core of it. We can actually expect the markets to go up in steady rate regimes and in hiking rate regimes, whereas statistically we can expect the markets to go down in rate cut regimes. But of course that is not, as I mentioned, because of the rates, but because of the overall economy, and the overall economy is usually pretty bad, in a pretty bad condition, when the Fed and the government thinks that we need a rate cut. All right, that's the first part of it. So let's have a look at the next part of it, and that is the sectors. Now, what we have done here is exactly the same. We have looked at the same set of data from 80 to, this one only to 21 here. But the rate regimes are the same here, and these are taken from the sector data from Pharma and French, their database here. And as you can see, we have the consumer non-durables, consumer durables, manufacturing, energy, and so on. All the sectors that we know. I know there are a couple of different sector systems. The one used in the ETFs with XLU and XLV and so on is a bit different. But I think you can get the overall picture here. Now, when we take and put all this data into a graph, it looks like this. This is also the CAGR, meaning this is showing how much the different sectors are producing in CAGR, meaning in, you could say, an average yearly return. That is about it. And you can see how much they are performing in the steady time, that is the blue, and in uptime, that is the orange brown bar here, and in down times, that is the gray, and that is also the interest rate regime we are talking about here. All right, so what we can see is that in the steady in the steady times, with the rates going steady, maybe a bit up and then a bit down, but basically just steady sideways, staying the same, we can see that all the blue bars are above zero, and they are well above zero, meaning that in steady rate regimes everything is going up. We can see something is going a bit more up than others. We can see consumer durables, that is over 40% in CAGR here, but we can also see some manufacturing, we can see some tech, telecom, retail, and so on. The economy is overall steady, and people know what they can expect. There are not any black clouds in the sky. In the rate hike periods, that is the orange bar, that is when you could say that the economy is really running hot, and the inflation is growing, and Fed needs to hike the interest rates as of right now, because everything is running a bit too fast. Now you could see that the sectors you might want to have an extra look at here is manufacturing, that is the highest bar here. It is energy, of course, a lot of energy is used, gas and oil and stuff. Tech is also growing nicely, and you can see that others, and I should say that I will see if I can put a link to the description of these different, there are some minings and some other stuff in these others sector here. But you can see that overall also, the only one actually that is way up, or there are a couple that are consumer non-durables, only going up by around 10% per year in these uptick periods, and we have the telecom. That is, of course, not because they are all of some bad sectors, it's just that there are more focus on some of the others. The really interesting part here is that when rates are cut in the periods where we are lowering the interest rates, we can see that there are actually, on average, this is pure statistical, and that can be a lot of lies inside of stats here, but we can see that in these periods where the economy, the overall economy, expectedly is somewhat worse than normal, you can see that the consumer non-durables is actually on average going up a bit by 4% per year. Now, the non-durables are what you eat, what you drink, all of the stuff that doesn't last here. We can see that telecom is decent. We can see that utilities, this is water, electricity, and so on. People still need that, and there is a tendency that in tough times in the economy, people buy a bit more stocks in the utility sectors because they know that people always need that. The same with retail. People still need to put some money in the retail, and there is, of course, the healthcare, which is also, people still keep getting ill and sick even though the economy is in shambles. So yes, healthcare is also a normal place to look for. So this is, in my opinion, a very interesting perspective of this rate hike, rate cut scenario that actually shows us that even though we are getting into an area of rate hikes, we can actually expect, at least statistically, some rising stock prices. And we could say that if we are going into an area, which we must expect here in 22 and 23, with some heavily rising interest rates due to a big rise in the inflation, well, manufacturing, energy, tech, and this other category that I will put a link to in the descriptions below, that is definitely somewhere you should take an extra look at. But overall, the market will, if the historical stats are true, it will go up even though the interest rates are going up. There will be single companies that are hit terribly hard by these rising rates, and that is what I often talk about when I'm talking about the debt to equity, also the interest rate, the interest coverage number, meaning how many times can they pay their interest rates with the earnings per share and so on. And personally, in a rate hike scenario as we are in now, I am personally looking primarily for stocks where we can see they can easily pay their interest rates. They will not be as hard hit by the rise in interest rates as more indebted companies. All right, that's all for now. I hope this made sense. Otherwise, you're welcome to post a question under the video or in our Facebook site or wherever you find us on the internet. That's all for now. I'll talk to you again shortly. Bye.